Welcome to Illuminati Silver. We tell you the truth about silver. Today is Monday the 30th of September 2019 and we're discussing one of the more important headlines in the news today. Interest rates and how low they're likely to fall. So let's investigate. It's Monday morning, 10:30 British Summer Time. And as one glances at the various news and economic sites, there are two overpowering headlines. The main one, Trump and Ukraine, and the second one, slightly less prominent, but they're nevertheless, central banks around the world either lowering interest rates or planning to. The Trump-Ukraine impeachment scenario is fascinating to watch, with the Democrats claiming it's abuse of power, and the president claiming the whistleblower is a traitor, or at least the person or persons who fed him or her the information are guilty of treason, and should perhaps be treated as previous traitors were treated once upon a time. He muses, while the respective party hackers follow in the shadows and repeat the talking points their respective leaders on both sides have issued them. Entertaining stuff, with possibly important consequences. However, we plan to concentrate on the interest rate issue, simply because politics is just divisive in today's world. And no matter what facts exist or may not exist, on one side or the other, they are ignored by the religion of bipartisanship. And unfortunately, we now all have to accept the fact that the obtaining of and then holding on to power is the most important goal of anyone involved in politics today, regardless of honesty, morality, or ethics. If, of course, it hasn't always been that case in the past. So, let's talk interest rates. It's no secret that the world's economy is in difficulty, with ever lower growth rates reported and predicted, with even the mighty China now questioning whether it can achieve its lowest growth forecasts of 6% per annum. The perceived wisdom of policymakers and central banks is to stimulate the respective economies via various measures, not least being to reduce interest rates. For in simple terms, the reduction of interest rates achieves two important factors. One, it makes money cheaper to borrow and therefore should encourage borrowing and then spending, and from a corporate perspective increase capital investment, though admittedly it all has to be paid back eventually. And two, it tends to lower the currency value in respect to others, thereby making one's exports cheaper and arguably more competitive, though on the other side, if you're a net importer, it makes your goods more expensive. The problem, of course, with this scenario is that if everyone adopts this strategy, then all that happens is that one country only has an advantage until the next one lowers their rates, which may only be a few weeks apart. And we then have the rather predictable race to the bottom of the interest rate spectrum. Now, when 0% is reached, there are three options. Reduce no more and just deal with the consequences. Move into negative interest rate territory, which some have done, or look at other ways of stimulating the economy either through fiscal measures, for example lowering taxes and increased government spending, or QE, where the central banks, through various means, injects additional money into the economy, or a mixture of all of these options, all of which have their own complications and consequences. Now, modern monetary theory, which we have produced a number of videos on, basically suggests that governments or central banks should print money and buy or invest their way out of recession, thereby preventing the adverse consequences that recessions normally impose. Whilst in theory this sounds great, the ultimate fear, of course, is the resultant hyperinflation and the destruction of that economy in its entirety once that occurs. The good news for you, our listeners today, is that we're not quite at that stage as yet, but we are heading slowly towards it. Now, in August of this year, the US Fed reduced its Fed funds rate by 0.25% for the first time in a decade. And in September, it reduced them further by another 0.25%, with the prospect of another rate cut envisaged this year. So we have interest rates currently standing at 1.75% to 2%. Now, whilst that may appear alarming, it is nothing compared to what other countries have done in recent months, with many countries now having rates at even lower levels. We'll give you a few examples, but they're by no means exhaustive. Canada, 1.75%, Norway, 1.5%, Poland, 1.5%, and South Korea, 1.5%. New Zealand, 1%, Australia, 1%. UK, 0.75%. Denmark, 0.5%. Israel, 0.25%. Europe, 0%. Sweden, minus 0.25%. And this may surprise many, Switzerland, minus 0.75%. Now, admittedly, on the other side of the coin, there are some countries with quite high rates in comparison. Turkey, 16.5%, Mexico, 7.75%, Russia, 7%, South Africa and Indonesia, 6.5%, Brazil, 5.5%, India, 5.4%, and China, 4.2%. Now, there's quite a divergence of rates, with China being at the bottom of this list, with the rates some 2.5% higher than the top of our first list, being Canada. Now, of course, there are obvious reasons why these latter countries have such high rates in comparison, but a number of these have been lowered at least once in the last 12 months. Save Sweden, which actually increased from minus 0.5% to minus 0.25%. But that was back in 2015. And the other countries marginally moving up have been UK, Canada, Israel and Norway, many of which are now predicting the next move back down. Now, it was reported by Reuters today that, quote, sovereign bond yields across most major emerging Asian economies will slip in the months ahead, as all central banks across the region are expected to cut interest rates further to nurse their economies back to health. A sharp slowdown in these export-reliant economies, as the US-China trade war worsened, has pushed policymakers to either trim rates significantly or signal more easing soon. That has led to increased demand for low-risk government debt in the region, pushing yield curves to invert in Singapore, Thailand and Hong Kong, meaning short-term yields are higher than long-term rates, which many experts in developed markets consider an indicator of an impending recession, unquote. Now it further adds, quote, China's 10-year note yield has declined more than 10 basis points, while in Singapore, South Korea, India, Indonesia, Thailand and Malaysia, yields have fallen 30 to 90 basis points this year so far. The Philippines' 10-year government bond yield has slumped as much as 230 basis points, unquote. Now, we have already produced a video on the meaning of an inverted yield curve, and again we put a link in the description box below. But it normally leads to a major growth slowdown or recession, albeit some 12 or 24 months ahead. The difficulty which many policymakers have can be concluded by the words of Richard Yetsenga, chief economist at ANZ, who told Reuters, quote, the impact of monetary policy is diminishing more broadly than just across the core of Asia. The limited effectiveness of policy in Japan and the EU is self-evident. But even in the US, with still 200 basis points between the Fed funds rate and zero, policy is not packing the same punch, unquote. So with the ECB planning to introduce new financial stimulus, a member of the Bank of England suggesting on Friday that because of Brexit, the next interest rate movement is likely to be downwards, with Asia suffering slower growth and the US markets expecting the Fed to cut rates at least once more this year, and the US president demanding that it cuts rates to zero, one does have to ask, where does all of this end? Especially as Richard pointed out, the impact of monetary policy is diminishing. And so other tools will be required. Otherwise, the world will most certainly enter into a global recession. Now, for interest, at the time of writing, gold is down $9 this morning at $14.87, and silver is down 24 cents at $17.30, more or less as we anticipated in our weekly update published on Saturday. And we still contend that both will go lower short term, especially as the dollar index is holding firm at 99.1. Ironic, is it not, that although we expect our currency to devalue, the dollar is still holding up extraordinarily well. And precious metal prices, which normally rises when interest rates fall, are falling currently. How long and how low do you think interest rates will go in the US, UK and Europe? And what other options do they have to encourage or re-encourage growth once again? Do share your views. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners. Glory, glory.